Jim, the data out of the U.S. are pretty bullish. Here's one bit. Lower mortgage yields and a surge in refis are adding to four-year lows in gas prices to give consumers more disposable income. So here's the big question. Are you upbeat on the U.S. right now?
No, Aaron, I don't think the data is bullish at all. For example, the data point you just gave, you talk about lower gas prices giving consumers more discretionary income. Well, lower gas prices put more money in their pockets. It doesn't mean they're going to spend it. They could use it to pay off debt, pay off credit cards, pay off their kids' student loans, pay down a mortgage, et cetera. In other words, there's an alternative to spending, which is saving or reducing debt, which is the same thing. So this easy connection between more money in their pockets and spending, that sort of treats the consumer like an automaton who doesn't know what to do with the money, is just going to go out and spend it, buy the 9th TV set. That's not what happens in the real world. In the real world, people are deleveraging and saving, so that's not particularly bullish. The other thing, gas prices going down, that's deflationary. Deflationary blows up the debt-to-GDP ratio, puts the U.S. on the path to Greece. In other words, deflation increases the real value of debt. We have a debt problem in this country, so why is increasing the real value of the debt bullish? That's the Fed's worst nightmare. So none of this is good at all. Let me put it differently. I don't consider these bullish indicators. They tell me that the economy is running out of steam. An economy is nothing more than two things. It's how many people are working, how productive are they. You can slice and dice it any way you want. You can take GDP and divide it into government and private, exports, imports. There are a lot of ways to finesse the data. But at the end of the day, how many people are working, how productive are they? Well, guess what? Labor force participation is going down, which means fewer people are working. And productivity recently is actually going down. It had expanded for a long time, but going down lately. Real wages are stagnant. 50 million people are on food stamps. 7 million people have part-time jobs, wish they had full-time jobs. So the kind of thing you mentioned, this is noise. I mean, these are day-to-day data points that people get spun up about, and you get a lot of happy talk around them, but they're not the real story.
Jim, a lot of people are concerned about Europe, and Reuters uncovered deep divisions at the ECB. And apparently, the head of the ECB and the head of Germany's central bank, they hardly speak. So does Europe need another economic crisis for them to circle the wagons?
Well, we're in a global depression. I mean, there's slowdown in China, Japan, Europe, certainly. I just described how the U.S. is slowing down. So the whole world's in a global depression. So there are enough problems to go around. But in a fight between the ECB and Germany, Germany wins. So I don't look for much change. I mean, ECB, there was a whole buzz today about ECB buying assets as if they're doing quantitative easing. I mean, they bought about $2.5 billion worth of assets, versus the Fed, which has been doing almost $1 trillion a year, $1 trillion a year, and the ECB does $2.5 billion. That's nothing. So yeah, they're going through the motions, but they're not doing anything like QE. They're not buying sovereign debt. They're buying some asset-backed securities, and there aren't even enough of those to have much of an impact. So Draghi, I do think, is the best central banker in the world. He understands that central banks are essentially impotent, and when you're impotent, you have to talk a good game. So Draghi, he says little and does less. The Fed is the opposite. The Fed doesn't quite understand how impotent they are, so they're out there yakking all day long and giving speeches and all of that. But at the end of the day, central banks don't make that much of a difference. They can cause inflation and deflation. They can make things worse with bad policy, but they can't make things better. To get out of a depression, you need structural changes. You need things coming from leadership, which there's a lack of in the United States these days. But the Congress, the White House, or in Europe, the individual governments, the 17 or 18 now members of the Eurozone, need to make structural changes. Those are things like labor force mobility, Fair Labor Standards Act in the United States, building the Keystone Pipeline, infrastructure, social costs. These are the structural changes, taxes. These are the fiscal and structural changes that have to be made to get us out of a depression. This unbounded faith in central bankers is nonsense. They've done nothing but they are capable of destroying wealth, but they're not capable of creating it.
So, Jim, how much, can easy money help if it leads to cheap euro, say, dollar-euro parity?
Well, just listen to your question, Aaron. How can easy money help at all? I mean, printing money doesn't create jobs. Central banks don't create jobs. As I mentioned, we need structural changes. Now, the problem, as I mentioned earlier, is an economy is just, working at how big is the labor force, how productive are they? That's all there is. Now, with labor force participation going down and productivity going down, there's no way the economy can expand except by credit creation. You can create credit, but all you do when you do that, the easy money, you don't actually create real wealth, you create asset bubbles. But then the bigger the asset bubble gets, it explodes, it does more harm than good, puts you actually back worse than where you started. And so that's sort of what we're heading for now.
So how does the current struggle in Europe fit into your currency wars thesis?
Well, it's part of the currency wars. The currency wars, as you know, started in 2010. I talk about this in my first book, Currency Wars. And the point I made at the time was that we're not always in a currency war, but when we are, they can go on for 5 or 10 or 15 years. So I'm not at all surprised that for a currency war that started in 2010, here we are in 2014, and it's still going on. Now, a lot of journalists and reporters, you know, when there's a big story, you know, we see the Brazilian real collapsing with the re-election of Rousseff and others. They say, well, the currency wars are back on, but they never went away. The currency wars don't go away. They just have, you know, sort of high points and then quiet periods. But you know, we've come through a recent period of the strong dollar. Well, the strong dollar is deflationary. By the way, currency wars are an alternative to interest rates. Interest rates and exchange rates are just reciprocal to each other to a great extent. So when you're at the zero bound, which the central banks are, one way to ease is by cheapening your currency. Well, the opposite is true. When your currency gets stronger, that's a tightening move. So the combination of Fed tapering and a stronger dollar, which is what we've seen over the last year and a half, is very deflationary from the U.S. perspective. It's one of the reasons the U.S. economy is slowing down. So those policies probably have to be reversed. I would look for certainly, you know, possibly QE4 next year and a weaker dollar, stronger euro as easy moves on the part of the U.S. The U.S. has tolerated a strong dollar and gone through tapering because we mistakenly believed that our economy was getting a lot stronger based on second quarter GDP. But a lot of that was just inventory accumulation. You look at the first half as a whole, if you back out inventory accumulation and replace it with final sales, the economy grew, you know, less than 2%, which is what it's been doing for the last 5 years. That's a depression. Defined as, you know, a depression doesn't mean declining GDP. It just means below trend GDP. If your GDP trend is 3.5% in the long run and can be 5 or 6% in the short run as you bring labor back into the workforce, and you're actually growing about 1.9, that's depressed growth. That's what a depression is, and that's what we're in right now. So I expect currency wars to continue. Europe got a little lift, you know, from a cheaper euro that is designed to get some inflation into Europe because they have a big deflation problem now. But it's as if the U.S., you know, put the euro in the lifeboat, but now we got to kick them out because we need the lifeboat ourselves.
Mm-hmm. Now, I mean, speaking of problems, Danone and Unilever reported soft consumer demand in China, and it seems like the housing slowdown is crimping household balance sheets. So what impact will this have, Jim?
Well, China is the biggest credit bubble in the world. I mean, we just spoke about how the U.S. has created asset bubbles in housing and stocks with easy money, and that's true. But there's no bigger bubble in the world than China. They have a greater capacity to keep it going because their investors have fewer alternatives. You know, a Chinese middle-class investor, saver, they're not allowed to invest in foreign stocks. They don't like to invest in their own stock market because it's had its own problems. It's been very weak. They have invested in real estate, but they've created a bubble, and they're now backing away from that. They don't want to leave their money in the bank because they get kind of 25 basis points or something. So what they have invested in, the only two alternatives are gold, which they're buying in enormous quantities. You look at the purchases coming out of the Shanghai Gold Exchange, they're astounding. They're in the thousands of tons per month, which is you know, an enormous amount of gold. But the other alternative are these wealth management products. Well, the wealth management products, they're just you know, CDOs, like collateralized debt obligations. The banks that issue them or sponsor them, they're not bank guaranteed products, by the way. They're not bank deposits, but they're sold through banks. They take the money and invest it in worthless real estate. So the saver, the investor, thinks she's getting, you know, a 5 or 6% yield on a nice, you know, it's a high yield instrument, but they don't quite realize that A, the bank doesn't stand behind it, B, the money's being put into worthless real estate that can't pay off the debt. So that's a Ponzi scheme waiting to collapse. So, you know, you look around at China, you've got a housing bubble ready to collapse. You've got a wealth management product Ponzi ready to collapse. Now, China does have enormous reserves that they can use to bail out their banking system, but they tend to be very slow decision makers. In a financial crisis, slow decision-making is fatal because it allows the panic to spread before you can get on top of it. So probably what Chinese banks will do is, you know, if you've got depositors, you know, banging at your door for their money back, and you look at your balance sheet, and you've got, on the asset side, you've got a bunch of dud real estate projects that you can't sell, and perhaps you have some U.S. stocks and bonds, you're going to sell the U.S. stocks and bonds because they're liquid. That's how the contagion will go from China to the U.S. and spread around the world. So I'm not sure which is going to collapse the system first, something in the U.S. or something in China. Either one is a possibility. A few other wild cards in the deck, like this Swiss gold referendum coming up on at the end of November.
Jim, how far does Chinese growth have to fall to make a successful rebalancing a possibility?
Well, it's, China's about 10% of global GDP. So if it fell by half from the, let's say, the 7.5% range to maybe the 4% range, somewhere in there, that's going to knock, kind of 5 points off of a global GDP. So that's a lot. Now, but again, this will add to the deflation. The problem is I don't see the rebalancing, because the rebalancing is supposed to be from investment to consumption in China, inside China. The problem is most of the investment's been wasted. It's 45% of their GDP. If you start reducing the investment component, that has to, because it's such a large percentage of GDP, that has to go down faster than the consumption piece can come up. And if you have a credit crisis in China, that's going to ding confidence and make consumption even tougher. So it's hard to see how China gets out of that. They've been trying to cheapen their currency, again, back to the currency wars, but I think the U.S. has probably got limited tolerance for that. So there's sort of the thing is, Aaron, there's no good way out of this through monetary policy, because monetary policy cannot solve a structural problem. The whole world needs to restructure. Japan, the U.S., China, and Europe all need to restructure. Of those 4 areas, the only one that's actually doing the restructuring is Europe. That's why their growth is suffering, because that's part of the price you pay. But the U.S. and China and Japan are trying to pretend that everything's okay. But by not making the structural adjustments now, they're going to have worse collapses later.
Where will oil go if China continues to go away from infrastructure and export-led growth?
Well, China is becoming one of the world's largest oil importers. They may be at that point already. They have enormous demand for energy. Of course, they burn a lot of coal, but coal is, poison the air and poison the water over there. So there are limits on that. But if China slows down, they might use less. The thing is, energy prices move on 3 vectors. The 3 vectors are: one is, basic supply and demand. So what are the industrial uses for industrial inputs, and what's the supply side? Supply side looks very good right now, and to the extent the economy is slowing down, that weakens the demand for it. There's some talk that maybe Saudi Arabia is purposely suppressing the price of oil to put pressure on the Russians to back away from their support for Assad in Syria. I haven't seen any direct evidence of that. I don't expect to. That would be the kind of thing that would be a very closely held secret between the major governments of the world, but I don't think you can rule that out. The other factors are, inflation, deflation. Well, we just talked about how the world's deflating, so that tends to put downward pressure. The third factor is geopolitical. Even with the Islamic State, the interesting thing about the Islamic State is they're pumping oil. In other words, all these there are trouble spots all over the Middle East, but all of them want to pump oil. We saw something similar happen in 1986 in the Iran-Iraq war. A lot of people said, oh, gee, two of the biggest oil powers are at war. That's going to cause disruption in supply and cause the price to go up. And I said, no, it's the exact opposite. When you're at war, you need the money, so you pump more, and it brings the price down. I think the price of oil went down to like $12 a barrel at that time, maybe a little bit less. So, so with all the turmoil in the Middle East, unless people start actually, blowing up fields and, sinking tankers, which is not going to happen because the U.S. military would prevent that, they would tend to produce more to get money to prop up their wars. Which is what happened in the mid-1980s. So all of the arrows are sort of pointing downward at this point, so you might even see even lower oil prices.
How can the Russian economy cope with this?
Well, they might have to hunker down a little bit. Russia, I've always understood, is not a real functioning economy. It's more of a kleptocracy, with a bunch of gangsters basically skimming the oil revenue, so there might be a little bit less to go around for the oligarchs, although I don't think there are any hardship cases. But look, Putin will probably, he might actually cause more trouble on the international scene to distract attention from the internal economic problems. That's a classic strategy. You might see that in China, in East Asia, and you might see it in Russia, in Eastern Europe, and Central Asia. In other words, when leaders feel that they're in danger of losing support, they might cause foreign, invade foreign countries, invade their neighbors, cause other types of geopolitical problems to, kind of pump up national pride, distract attention from their economic problems. That's the oldest trick in the book. So one of the things Putin might do is just kind of more adventurism. He gave a very interesting speech over the weekend. I think he was participating in a very prominent think tank conference, and he said the bear is master of the taiga. The taiga is the Russian sort of primeval plain and forest, and when he said the bear, of course, he meant Russia, and he was warning the United States to keep out of the Russian sphere of influence. So that's, I think, is a pretty good indication of what Russian foreign policy is these days. So they might actually be more adventuresome and cause more problems.
It's very possible. So, where do you expect flashpoints to occur if oil prices continue to stay weak?
Well, there are flashpoints all over the world. Obviously, the South China Sea, the geopolitical flashpoints would be, South China Sea, the Senkaku Islands between China and Japan, obviously Ukraine, Central Asia, Venezuela could blow up. So these are all potential problems. But I would say that we sort of see all of them. These things could get worse. Ebola is another one, the Islamic State. It's a long list, unfortunately. These things could all get worse, but they're all on the radar screen. The thing that I'm more concerned about that could really cause a financial panic and cause the sort of house of cards to collapse is the thing that we don't see, the thing that we're not thinking about. That could be something like an unexpected bank collapse or an unexpected failure to deliver gold by an exchange or a major broker, something more like an MF Global where it kind of comes out of nowhere, catches people by surprise, and starts a liquidity crunch. So I think that's probably more troubling than the geopolitical flashpoints, because at least we can see those and discount them to some extent.
Now, I understand bond markets are concerned because Venezuela may default. So if they did, given Argentina already defaulted, could there be contagion?
Sure. When the question is when somebody defaults, you can see the defaults coming. What you don't know is who are the creditors. You don't necessarily know that. You may have some information on that. So it's sort of like when AIG failed, the big loser wasn't AIG, it was Goldman Sachs. Goldman Sachs, was probably insolvent or close to insolvent at the time. And the bailout of AIG was really a bailout of their major creditor, which was Goldman Sachs. So the same thing is true today. When you see Venezuela collapsing, you have to say, well, okay, we know who the debtor is, who are the lenders, where's the AIG that's in line after Lehman, or the Goldman that's in line after AIG. What's the next domino that's about to fall? That's harder to know. Again, that's true all over the world. It does kind of remind you of the 1930s when these failures started popping up. People started going off the gold standard, defaulting on their debts, imposing capital controls, et cetera. And then there was a super catalyst with the failure of Credit Anstalt in 1931. But there were some warning signs ahead of that. I do see the warning signs today.
Any thoughts on Japan, Jim?
They've been in depression for 25 years, and if they don't make some changes, they'll be in depression for another 25 years. It goes back to what I was saying earlier. You can't print or deficit finance your way out of a depression, at least if you're wasting the money, which they do. There are people in Japan who say, the road in front of my house has been paved, 5 times in the last, 10 years. It doesn't need that much paving. There are things that Japan could do structurally that would help. Cut taxes, allow greater immigration, empower women, increase the role of women in their economy, break up some of the big banks, force some companies into bankruptcy, make improvements in their kind of very antiquated retail distribution system. There are a lot of things that Japan could do, but they're not doing any of them. So why would it change?